Hello, friends. Very enlightening evening to all of you. It's really a very amazing experience to address you once again on this great economic forum. Dear guys, we are going to discuss the very important aspect for our economy. That is, we are going to discuss the core intricacies of the budget, the conceptual framework of the budget. That is, to the layman, what do you mean by a budget? We are going to develop a very comprehensive idea about this particular concept. And before beginning with this particular discussion, I would like to throw some light on the recent developments being done by our respected ministers as they are holding the meetings on continuous basis in order to analyze what are the important points they need to consider, they need to keep in their mind while framing the budget for this year 2023 to be released on 1st February by the Finance Minister Dr. Nirmala Sitharamanji. So, dear friends, let's analyze, let's try to see what all points do they consider relevant in this particular aspect. Basically, as per their overall analysis, they feel that the budget needs to offer the growth impetus. This is the basic advice being given by the leading economists of the country to the Prime Minister Shri Narendra Modi ji. India may have emerged as a bright spot in an otherwise turbulent global world, but the government actually needs to provide new growth impulses in the upcoming budget to build on it. The leading economists conveyed to the Prime Minister Shri Narendra Modi ji at a pre-budget consultation. They also offered several suggestions to lift the agriculture and manufacturing sectors to help the country sustain its development momentum holistically. The participants in the meeting offered practical measures on ways in which India could prudently sustain its domestic development in terms of pacing up the momentum across the sectors ranging from agriculture to manufacturing. An official statement said on Friday. That is, as per their overall analysis, India needs to develop on the primary sector front as well as on the secondary sector front. So various measures have been advised by them which are quite practical, on which India can actually sustain its overall development in both these sectors. So, one of the suggestions at the meeting was basically to enable the farmers to generate power via solar, which will also help in boosting their income. People familiar with the deliberations told Economic Times. At the meeting organized by the Niti Aayog on the theme India's Growth and Resilience Amidst Global Headwinds, Modi ji asked the public and private sectors to leverage the synergies and think out of the box to seize the opportunities arising as a result of the emerging global environment. That is, to find out the ways with out-of-box thinking to actually find out the opportunities the present crisis are offering. I repeat, you may find my statement quite absurd or quite different, but it's the only solution as we have been discussing in all our sessions. that we need to be very, very extraordinary in our overall process of thinking and devising our strategies and the overall framework of policy making. For instance, in the recent crisis, that is the health crisis of COVID, we have developed immensely to prosper in terms of digitization. This is actually commendable. That is, we need to possess the very, very perseverant attitude with the presence of mind. That is, how can I take the best advantage of my core innate strengths as a country? This is the basic trait of the charismatic leader, and this has been advised by our respected Prime Minister, Shri Narendra Modi ji, and that's why he is the great leader. Further, moving ahead, Modi ji said, while there were risks, the emerging global environment offers the new and diverse opportunities in areas such as digitization, energy, healthcare, and agriculture. So in order to seize these opportunities, the public and private sectors need to leverage synergies and think out of the box. The PM underscored the Nari Shakti as a key driver of India's growth and urged to continue making efforts to further enable and boost women's participation in the workforce. Modi ji also highlighted the need to promote the millets in view of their overall potential to transform the rural and agricultural sector with their attributes such as being carbon neutral, conducive to natural farming, and an affordable source of nutrition. So we can see that our respected Prime Minister, the ever dynamic leader, is actually helping us to count on our strengths, and hence there is the dire need to start capitalizing on them, to actually develop them as our USP. This is really marvelous, and this is the actual way of actually doing innovation and actually emerging as a leader in such turbulent times also. The statement further said that the PM also applauded the success of India Digital Story, the rapid adoption of fintech across the country, and the potential for inclusive growth and development it promises. The Finance Minister, Dr. Nirmala Sitharaman, Minister of State for Planning, Mr. Rao Inderjeet Singh, Niti Aayog Vice Chairman, Ms. Suman Berry, and top officials of the Niti Aayog, the Prime Minister's office, as well as the Finance Ministry also attended the meeting. The Finance Minister will present the budget 2023-24 on February 1. And several economists also attended the meeting, including Mr. Ashok Lahiri, Mr. Shankar Acharya, Ms. Indira Rajaraman, Mr. Ashok Gulati, among others. So dear friends, we find this discussion to be very, very related and very useful for actually the upcoming budget 2023-24, as in this pre-budget meeting various economists and ministries have discussed in detail, that is, how to make the budget a great success and very useful for the entire development of the masses across the nation, and also how we can help the global economy to boost their overall confidence in order to deal with the current crisis. And that can be than only with the sense of the global family or the basic sense of belongingness, as I have been propagating in all my sessions. This is the basic foundation which should work in the thought process, and the ministers are working in this very thought process. So now, dear friends, as I had discussed in the beginning of this particular session, that now I would actually elaborate and explain the concept of budget. That is, what is a budget? So let's move to this particular part. Hello. So now, my dear friends, we are basically now discussing the basic framework of the government budget and economy with regard to the Indian economy. Dear friends, all of us are quite aware of the term budget. In layman language, a budget is basically a document wherein we actually list the expected expenses and the expected incomes for the upcoming period, right? And then we plan out our various strategies how to manage our overall finances accordingly. So this is a very useful framework for the planning purposes. Now, the same concept can be further enhanced or can be further used for the nation, for the country. Though this is being performed, the budget is actually being made at the state level by different state ministers and also at the central level. In this particular session, we are discussing the role of budget making at the central level, that is by the central government of India. So here it goes. And 1 minute, we are actually discussing this particular aspect under the forum of Nagpur Economic Academia, right? So in the modern world, every government aims at maximizing the welfare of its country. That's the basic objective. So it requires a number of infrastructural, economic, and welfare activities. All these activities basically require huge expenditure to be incurred. So this requires appropriate planning and policy of the government. The solution to all these problems is budget. So a budget is a document containing the detailed programs and policies of action for the given fiscal year. Right? Now let's move towards the formal definition of the government budget. A government budget is actually an annual statement showing item-wise the estimates of receipts, that is the income, and the estimates of expenditure, that is the outgo, during a particular fiscal year. The receipts and expenditures shown in the budget are actually not the realistic or actual figures. They are not the actual figures, but the estimated values for the coming fiscal year. Hence, this is a very, very useful roadmap. The fiscal year is generally taken from 1st April to 31st March. Now, let's go through the important points of the government budget. As we have discussed, the budget is basically prepared by the government at all the levels, that is the central government, state government, and the local government, who prepare the respective annual budget. However, we will restrict our studies to the budget of the central government known as the union budget. The estimated expenditures and receipts are basically planned as per the objectives of the government. In India, the budget is presented in the parliament on such a day as the president may direct by convention The finance minister usually presents the annual budget of the government on the first day of February each year, as we had discussed in this very session, right? It is required to be approved by the parliament before it can be implemented. And the budget reveals the financial performance of the government in the last year and the financial policies for the coming fiscal year. Very true. Now let's discuss the objectives of the government budget. The government prepares the budget for fulfilling certain set of objectives. These objectives are the direct outcome of government's economic, social, and political policies. The various objectives of government budget are as follows. That is, the reallocation of resources, then reducing the inequalities in income and wealth, economic stability, that is the main objective to procure economic stability in the nation. Then the management of public enterprises. Then comes economic growth, and then reducing the regional disparities. This is very important. That is actually emphasizing on the concept of equal development across all the states, hence reducing the disparities among various regions of the nation. And very important objective is employment generation. So in terms of reallocation of resources, through the budgetary policy, the government basically aims to reallocate the resources in accordance with the economic, that is profit maximization, and social, that is public welfare priorities of the country. The government can influence the allocation of resources through tax concessions or subsidies, directly producing the goods and services. So this is very important. In this particular regard, I would like to state that in terms of directly producing the goods and services, these goods are referred as the public goods. So the public goods are those goods or services that are collectively consumed. It is not possible to exclude anyone from enjoying their benefits, and one person's consumption does not reduce the availability of others. That is, it is uniformly available to each and every individual across the entire nation. So the two main features of public goods are, the public goods are actually non-rivalrous. That is, the benefits of the public goods are available to all and are not only restricted to one particular one particular consumer. For example, if we consider a public park, the benefits of that park will be available to all. Secondly, the public goods are non-excludable. That is, in case of the public goods, there is no possible way to exclude anyone from enjoying the benefits of that particular good. Due to this reason, the public goods are called non-excludable. So even if some users do not pay, it is actually quite difficult to collect the fees for the public good. These non-paying users are known as free riders. Now, in order to understand this concept better, let's understand the concept of private goods as well. The private goods are those goods or services whose benefit accrue to the people who pay for them. For example, the chocolate purchased and consumed by a person will benefit that person only and not the public at large. Now, the second objective of the government budget is to reduce the inequalities in income and wealth. The economic inequality is an inherent part of every economic system. The government aims to reduce such inequalities for the basic purpose of holistic development of all components of the society. So, to reduce such inequalities in income and wealth perspective, through the budgetary policy. The government aims to influence the distribution of income by improving the taxes, by imposing them effectively on the rich and spending more on the welfare of the poor. So it will reduce the income of the rich and raise the standard of living of the poor, thus reducing the overall inequalities in the distribution of income. For instance, the free LPG connection, that is a liquefied natural gas connection under the Pradhan Mantri Ujjwal Yojana, and food grains at a very nominal price to the BPL families, that is the below poverty line families, by the government, helps to raise the quality of life of the BPL population. Now, another objective is to attain economic stability in a country. Economic stability basically means absence of large-scale fluctuation in prices. Such fluctuations basically create uncertainties in the economy. The government can exercise control over these fluctuations through taxes and expenditures. In this regard, I would like to tell you that the taxes imposed by the government are the earnings for the government. They are the income for the government, as we had discussed in the last section, right? And the expenditure of the government is the outflow of money to the government sector. The inflationary tendencies basically emerge when the aggregate demand is actually higher than the aggregate supply. The government can bring down the aggregate demand by reducing its own expenditure. Very true. And we are going to discuss this in our upcoming section, when we will discuss the concept of budgetary deficit. In this very session itself, we will introduce the concept of surplus budget. That is, what is the surplus budget? What is the basic concept of surplus budget, and how it is overall mechanized, or how it is overall mechanized by the government during inflation to actually ease the situation of inflation. On the other hand, the deficit budget is actually brought in by the government during the deflation, hence helping to maintain the stability of prices in an economy, right? So, during inflation, the government tries to bring down the aggregate demand by reducing its own expenditure. And during deflation, the government can increase its expenditure and give tax concessions and subsidies. The basic objective in the subject of economics is to attain equilibrium, attain a point of balance, right? So that's what this particular point emphasizes upon. Now, the next objective is the management of public enterprises in an effective manner. There are large numbers of public sector industries, especially the natural monopolies, which are established and managed for social welfare of the public. The budget is actually prepared with the objective of making various provisions for managing such enterprises and providing them the financial help. Now, the government operates, manages and controls the natural monopolies like railways, post offices, electricity, etc. to promote the public welfare. Now, the next objective is obviously economic growth. The economic growth implies a sustainable increase in the overall real gross domestic product of an economy, that is the real GDP. That is, an increase in the volume of goods and services produced in an economy. The budget can be a very effective tool to ensure the economic growth in a country. So, if the government provides the tax rebates and other incentives for the productive ventures in projects. It can actually stimulate savings and investments in an economy, helping the economy to prosper at a very effective level. Secondly, spending on infrastructure of an economy basically enhances the production activity in different sectors of the economy. The government expenditure is actually a major factor that generates the demand for different types of goods and services in an economy, which induces the growth in private sector as well. However, before planning such expenditure, rebates and subsidies, the government should check the rate of inflation and the tax rates. Also, there may be the risk of debt trap if the loans are too high to finance the expenditure. We are basically going to have a very broad-minded discussion in this particular aspect when we are going to discuss the topic of budgetary deficit. As of now, we are discussing the objectives in a very comprehensive manner, wherein we are developing the overview of the entire topic, right? Covering the entire gamut of the various components, right? Now, the next very important objective is to reduce the regional disparities in the country. The government budget aims to reduce the regional disparities through its taxation and expenditure policy for encouraging the setting up of the production units in the economically backward regions. For example, establishment of special economic zones, that is SEZs, in the backward regions help to promote the overall economic development. Now, the next very important objective is employment generation. The government budget is actually used as an effective tool in the process of employment generation in various ways. Investment in infrastructural projects like the construction of flyovers, bridges, expansion of roads, etc. creates the jobs for different sections of the workforce. In rural or urban areas, the government aims to provide the jobs through various employment generation schemes like MGNREGA, SJSRY, PMRY, etc. These are very prominent schemes introduced by the government to generate and actually enhance the overall employment prospects in the economy. Now, let's discuss the components of the budget. If we talk broadly, we can categorize the budget in two ways, that is budget receipts and budget expenditure. In the layman language, what does receipts mean? The receipts mean the income, what we are receiving from the other end, that is the inflow, that is the inflow of money if we talk in terms of the budget. So this is further categorized into revenue receipts and capital receipts, correct? Similarly, the budget expenditure. Now, what does the expenditure mean? It means it means the basic outflow of money from my side to the other side, right? So it can also be further categorized into revenue expenditure and capital expenditure. We are going to develop the basic understanding of these categories, that is revenue receipts, capital receipts, revenue expenditure and capital expenditure. So these are the basic categories. The other way of the categorization of the budget is revenue budget and capital budget. In case of revenue budget, we will consider the revenue receipts and revenue expenditure, and in case of capital budget, we are going to consider capital receipts or capital expenditure. So we can work in either way. So here I have taken the first way of categorization, that is the budget receipts and budget expenditure, correct? So first of all, let's develop the basic understanding of revenue budget and capital budget. The revenue budget basically deals with the revenue aspect of the government budget. It explains how the revenue is generated or collected by the government. What is it? The revenue receipts. And secondly, how is that money allocated among various expenditure heads? So what is that? That is revenue expenditure. Hence, revenue budget has two parts, that is revenue receipts and revenue expenditure. Revenue receipts and revenue expenditure. In short, revenue budget is actually the statement of estimated revenue receipts and estimated revenue expenditure during a particular fiscal year. Now similarly, we are going to define the capital budget. The capital budget basically deals with the capital aspect of the government budget, and therefore it consists of capital receipts and capital expenditure. In other words, capital budget is the statement of estimated capital receipts and estimated capital expenditure during a particular fiscal year. So, as we had discussed in the beginning of in the beginning of this particular discussion of the components of budget, that is the components of budget can also be categorized according to receipts and expenditures. That's the basic that's the basic methodology I have adopted here. That is the budget receipts and budget expenditures. Now, let's discuss the concept of budget receipts. The budget receipts basically refer to the estimated money receipts of the government from all sources during a given fiscal year. That is, it will deal with the incoming of the money, the various sources from which the government estimates the incoming of money for a particular fiscal year. So this can be further categorized into revenue receipts and capital receipts. So the budget receipts refers to the estimated money receipts of the government from all sources during a given fiscal year. It may be further classified as revenue receipts and capital receipts. Now, as we can see here, the revenue receipts can be further categorized into tax revenue and non-tax revenue. Correct? The tax revenue is further categorized into direct tax and indirect tax. In case of direct taxes, we consider income tax, corporate tax, etc. And in case of indirect taxes, we are going to consider the GST, that is the goods and services tax, basic customs duty, etc. Then in case of the non-tax revenue, here we are basically going to consider the income coming in the form of interest, profits and dividends, fees, license fee, escheats, fines and penalties, gifts and grants, forfeitures and special assessment. So, what is the basic concept of revenue receipts? What is the basic concept? Let's understand. The revenue receipts refer to those receipts which neither create any liability nor cause any reduction in the assets of the government. These are those sources of income for the government which will not create any type of liability, and also at the same time they will not lead to the reduction of any type of asset. My dear friends, this is actually a very important concept whose fundamentals we need to understand at a very base level, because all discussion parameters will be based on this particular understanding of the revenue receipt, capital receipt, revenue expenditure and capital expenditure. So I repeat it once again. the revenue receipts neither creates a liability nor reduces any assets. That is, for the government, this type of receipt must not create a liability. For example, the taxes levied by the government are the revenue receipts, as they do not create any liability. This is the gradual, ongoing, recurring process. Any amount borrowed by the government is not a revenue receipt. The borrowing comes under capital receipts. As this causes an increase in the liability in terms of repayment of borrowings. Borrowings we need to repay, that's why it comes under the category of capital receipts. And the second important trait of the revenue receipt is it must not cause the decrease in assets. That is, neither causing the creation of any type of liability nor leading to the reduction of the assets for the government. For example, the receipts from the sale of shares of a public enterprise is not a revenue receipt, as it leads to the reduction in assets of the government. So this is a very important understanding of the revenue receipts to actually differentiate between revenue receipts and capital receipts. So in order to have a broad understanding, I would like to elaborate the basic differences between the revenue receipts and capital receipts. First difference is the revenue receipts neither create any liability nor reduce any asset of the government. On the other hand, the capital receipt creates the liability, or it will lead to the reduction in any asset of the government. Correct? Next, the revenue receipts are regular and recurring in nature. That is, the tax revenue and the non-tax revenue will be regular and recurring in nature, whereas the capital receipts will be irregular and non-recurring in nature. Now, in terms of future obligation, there is no future obligation to return the amount in case of the revenue receipts. However, in case of capital receipts, that is for the both cases of for the certain capital receipts like borrowings, that is the future, there is actually the future obligation to return the amount along with the interest. That is, for the borrowings we need to return the amount as well as the interest. So, now let's discuss the examples of revenue receipts and capital receipts. The revenue receipts examples are like tax revenue and non-tax revenue, as we have categorized here. Next, the capital receipts can be in the form of borrowings, recovery of loans, and other types of receipts, which we will discuss here. Right? So, coming back to the revenue receipts, wherein we will develop the understanding of the tax revenue. The tax revenue can basically be categorized into direct tax and indirect tax. The tax revenue refers to the sum total of the receipts from taxes and other duties imposed by the government. Tax is a unilateral or one-sided compulsory payment made by the people and companies to the government without reference to any direct benefit in return. Now again, we had discussed this topic in great detail while discussing the circular flow of income in the three-sector economy as well as in the four-sector economy. That is the government sector collects the taxes from the household sector and from the firm sector. So that's what is mentioned here. That is, it means that there are two aspects of taxes. The tax is a compulsory payment. No one can refuse to pay it. Secondly, the tax receipts are spent by the government for common benefit of people in the country. A taxpayer cannot expect that the tax amount will be used for his direct benefit. And also, tax revenue is the main source of regular receipts of the government. The government collects various kinds of taxes from the public to meet its day-to-day expenditures, and there is a strict action against anyone who fails to pay the taxes. Now we are going to discuss the types of tax revenue, that is direct tax and indirect tax. The direct taxes refer to the taxes that are imposed on property and the income of individuals and companies, and their burden cannot be shifted to the other person or entity. They are imposed on individuals and companies, and their mandatory burden in terms of money is actually borne by those on whom they are levied. The liability to pay the tax, that is the impact, and the actual burden of the tax lie on the same person. That is, its burden cannot be shifted to others. Right? They directly affect the income level and the purchasing power of people, and hence help to change the level of aggregate demand in the economy. Its examples are income tax, corporate tax, interest tax, wealth tax, debt duty, then capital gains tax, etc. Now we are going to discuss the concept of indirect tax. The indirect taxes are basically those taxes which can be shifted to another person or entity. Their monetary burden is ultimately borne by the financial users, by the financial users of the economy, who are actually the final users of those goods and services, rather than the person on whom the tax is levied. They are imposed on goods and services. The liability to pay the tax, that is the impact, and the actual burden of the tax, that is the incidence, lie on the different persons, that is the burden can be shifted to others. Now let's explore the examples of this particular category, that is the indirect taxes. There are various types of indirect taxes like the goods and services tax, the GST, basic customs duty, central excise and VAT, that is the value added tax on petroleum products, excise on liquor, electricity duties, stamp duty, securities transaction tax, property tax, entry taxes and toll, etc. Now, following the one nation, one tax system, all indirect taxes except the above mentioned indirect taxes have been merged into one single tax called the GST, that is the goods and service tax. Moreover, the indirect taxes can be avoided. That is, the indirect taxes are the compulsory payments, but they can be avoided by not entering into those transactions which call for such taxes. For example, the consumers may save the taxes by purchasing the Khadi Gram Udyog items, as there is no indirect tax on the Khadi items. So it depends entirely on the discretion of the consumer whether he or she wants to buy that particular item or not. If he or she buys, then he or she is obliged to pay that indirect tax. However, in case of the direct tax, it is mandatory for the person to pay that particular tax, which is in the form of income tax, corporate tax, interest tax, wealth tax, or the capital gains tax. Now, how to identify or classify a tax as the direct tax or the indirect tax? Dear friends, these are the core intricacies, and we are developing the fundamentals, the basic fundamentals, and we need to be familiar with these terms. It is very, very important. Then only we can actually develop the broad understanding of the budget making process in a very, very comprehensive manner. and then only we can be able to interpret the overall process. And we know that the budget is about to be announced on 1st February. Now, how we will be able to understand or interpret them? Only if we have the broad understanding of various concepts underlying this particular process of budget making. And being the responsible citizens, we need to be aware of this particular process. Hence, these terminologies play a very relevant role, like budget receipts, budget expenditures, revenue receipts, capital receipts, revenue expenditure, capital expenditure. Then, how is this revenue receipts further categorized, like tax revenue, non-tax revenue, as we have discussed. Now, further we can categorize tax revenue as direct taxes and indirect taxes. Now, what's the difference between the direct tax and indirect tax? These are actually very, very important points which we need to be very familiar with. So now, coming back, let's explore how to classify a tax as the direct tax and the indirect tax. A tax is a direct tax if its burden cannot be shifted. For example, the income tax is a direct tax as its impact and the overall incidence is on the same person, as we have just discussed. On the other hand, a tax is an indirect tax if its burden can be shifted. For example, the goods and services tax is an indirect tax, that is, the GST is an indirect tax as its impact and incidence is on different persons. Now, let's develop a broad understanding of the basic differences between the direct tax and indirect tax. I hope we are having a very good connect with each other. You are able to understand the concepts in a very conceptual manner. Correct? I'm going step by step, right? So, first of all, on the basis of impact, the direct taxes are basically levied on individuals and companies. On the other hand, the indirect taxes are actually levied on goods and services, right? Next, as we have just discussed, on the basis of shift of burden, in case of the direct tax, the burden of a direct tax cannot be shifted. That is, the impact and incidence is on the same person on whom the direct tax has been imposed. However, in case of the indirect tax, the burden can be shifted. That is, the impact and incidence is on different persons. Next point is the direct taxes are generally progressive in nature, whereas the indirect taxes are actually proportional in nature. In terms of coverage, the direct taxes have limited reach as they do not reach all the sections of the economy. However, the indirect taxes have a very wide coverage as they reach all the sections of the society. Now, let's discuss. I'm going to say certain taxes and we need to ponder whether these can be categorized into direct tax or in the category of the indirect tax. First is corporation tax. Think whether the corporation tax is direct tax or indirect tax. Please analyze all the factors which we have considered that is the basis of differentiation: impact, shift of burden, nature, or coverage. So I tell you that a corporation tax is the direct tax as the impact of the corporation tax is basically lying on the same person, and also the incidence also lies on the same person, right? For the goods and services tax, The goods and services tax, tell me whether this is direct or indirect. We have just discussed. Yes, many of you must have got right. It is the indirect tax, as its impact and incidence lie on different persons. Next, income tax, as we had just discussed, it's direct tax. Then the capital gains tax. It is also a direct tax, as its impact and incidence lie on the same person. Now, after having developed the broad understanding of the tax revenue, that is the first category of the revenue receipts, and the broad category of the broad category of budget receipts, we move ahead to the another category of revenue receipts, that is the non-tax revenue. Now, my dear friends, non-tax revenue basically refers to the receipts of the government from all sources other than those of tax receipts, right? Now, this can be in the form of interest, that is, the government receives the interest on loans given by it to the state governments, union territories, private enterprises, and general public. The interest receipts from these loans is an important source of non-tax revenue. To many of you, I just remind you, we are here. That is the non-tax revenues under the category of revenue receipts. We have reached here. So, for those whose attention might have got diverted, I repeat, the non-tax revenue refers to the receipts of the government from all sources other than those of tax receipts. So the non-tax revenue can be categorized under various heads like the interest, then profits and dividends, then the fees. Fees refer to the charges imposed by the government to cover the cost of recurring services provided by it. Then there is a license fee. For example, the license fee paid for the permission of keeping a gun or to obtain the national permit for the commercial vehicles. Then fines and penalties, and the fines and penalties refer to those payments which are imposed on lawbreakers. For example, the fine for jumping the red lights or the penalty for the non-payment of tax. The fines are basically different from taxes, as the former is levied to maintain the law and order, whereas the later one, that is the taxes, are imposed to generate the revenue. I hope you are getting the meaning. You are able to correlate the points we are discussing here. You are able to correlate them to the real life experiences of yours, that is the experiences of your daily life routines, because this is very, very related to your daily life, right? Now the next category of the non-tax revenue is escheats. It basically refers to the claim of the government on the property of a person who dies without leaving behind any legal hire or a will. Next, gifts and grants. The government receives the gifts and grants from the foreign governments and the international organizations. Sometimes the individuals and companies also voluntarily gift money to the government. Such gifts are not a fixed source of revenue and are generally received during the national crisis such as war, flood, etc. Next category is the forfeitures. These are actually in the form of penalties which are imposed by the courts for non-compliance of orders or non-fulfillment of the contracts. Next is the special assessment. It refers to the payment made by the owners of those properties whose value has appreciated due to the developmental activities of the government. For example, if the value of a particular property near a metro station has increased, then a part of the developmental expenditure is recovered from the owners of such property in the form of special assessment. Now, my dear friends, we are in a position to draw the difference between tax revenue and non-tax revenue. See, at various steps, we are discussing the differences. After developing a broad understanding, we are going through the differences between the two related items, and this is actually very important because we need to develop a very objective understanding. Correct? So this is the step-by-step procedure of going ahead. So, how can tax revenue and non-tax revenue be differentiated? Firstly, in terms of the meaning, the tax revenue refers to the sum total of receipts from taxes and other duties imposed by the government. Correct? And on the other hand, non-tax revenue refers to the receipts of the government from all sources as we have just discussed, other than those of tax receipts. Next, in terms of nature, the tax revenue is the compulsory payment imposed by the government, whereas the non-tax revenue is not a compulsory payment. It becomes payable only when the services offered by the government are availed. Next, if we talk in terms of benefits, in case of tax revenue, there is no direct benefit received from the government in exchange of the tax paid. Whereas in case of the non-tax revenue, the benefit is paid in exchange of the services received. The examples of the tax revenue, which will come under the category of the direct tax as well as the indirect tax, that is income tax, corporate tax, goods and services tax, etc. Whereas in case of non-tax revenue, as we have just discussed, various heads like interest, profits and dividends, fees, fines and penalties, escheats, gifts and grants, forfeitures and special assessment. Now, my dear friends, we are going to the second category of the budget receipts, that is the capital receipts. As we had developed the basic understanding of the difference between the revenue receipts and the capital receipts, on that ground, I would like to let you know that the capital receipts refer to those receipts which either create a liability or cause a reduction in the assets of the government. They are non-recurring and non-routine in nature. Now you must be able to correlate. Actually, in case of revenue receipts, we had said that these receipts neither create a liability nor cause a reduction in assets, whereas the capital receipts either create a liability or lead to the reduction of assets. The various categories in the capital receipts would be borrowing, recovery of loans and other receipts. Though we will understand this concept in detail. In case of borrowings, we are increasing our overall liabilities. The government is increasing its liabilities, that is, the national organization or the international organization from whomsoever the government borrows the funds. Obviously, it's a liability. In future, it has to return that particular amount along with the interest. So, it is the liability. So, this will be categorized in the capital receipt. Secondly, in the case of recovery of loans, in this particular category, the government's assets are getting reduced while recovering the loans. So, this is categorized under capital receipts. Though money is coming, but that is leading to the reduction of the assets of the government. So, this will be categorized in capital receipts. And there are other receipts as well in this particular category, which we are going to analyze in detail now. So, I repeat, the receipts must create a liability for the government. For example, the borrowings, which we have just discussed. The borrowings are the capital receipts as they lead to an increase in the liability of the government, right? However, if we want to understand the difference between the capital receipts and the revenue receipts, the tax received here, in case of revenue receipts, the tax received is actually not a capital receipt, as it does not relate to the creation of any type of liability. A tax collected by the government sector from either the household sector or the firm sector, it is not supposed to return that particular money to them. It's an income for the government, so it is categorized in the revenue receipt. However, borrowing leads to the creation of a liability, so that is categorized in the capital receipt. I hope you are able to understand the basic fundamentals. These are very, very important. Next, the receipt must cause a decrease in the assets. For example, as we have just discussed, the receipts from the sale of shares of the public enterprise is a capital receipt, as it leads to the reduction in assets of the government. Also, the recovery of loans. In case of the recovery of loans, the government grants various loans to the state government or union territories. The recovery of such loans is a capital receipt, as it reduces the assets of the government. I hope you are having a very clear understanding. You are developing a very clear understanding of these concepts. So, let's discuss the sources of capital receipts in detail now. Though we have developed a very practical understanding of these categories, that is how the capital receipts have been bifurcated into three categories. But still, let's go through the detailed analysis so that these concepts enter in our mind with proper meanings and with proper elaboration of this particular concept. The capital receipts are broadly classified into three groups as mentioned here: borrowings, recovery of loans, and other receipts. Now, in case of borrowings, the borrowings are the basic funds raised by the government to meet the excess expenditure. The government borrows the funds from open market, that is public, Reserve Bank of India, foreign governments like the loans from USA, England or other countries, international institutions like the World Bank or International Monetary Fund. So the borrowings are the capital receipts, as they create a liability for the government. Now, dear friends, you must be thinking that why are we developing such understandings? How will these concepts be useful? Dear friends, as I have highlighted here, this is very important. That is the budgetary deficit. This is the crux when we will come here, wherein we will try to analyze what's the equilibrium position, what's the point of equilibrium, whether we are in a favorable position or unfavorable position as an economy. When we will discuss the aspect of revenue deficit, fiscal deficit, and primary deficit. These are very important to analyze the overall health of an economy of a particular country. Now, in order to develop the broad understanding of these terms, revenue deficit, fiscal deficit, and primary deficit, we need to be very, very well versed with all these concepts very, very intricately and very, very precisely. That's why we are going through such a framework and that's why I have tried my best to present this particular analysis in such a manner so that you can have a very comprehensive idea of the entire framework. If you want, you can also capture the screenshot. You can also capture a picture of this board so that this gets relevant for you to actually clear your queries, right? Whenever you are stuck anywhere. Because this is the ongoing process and it's very, very important, very important. Now, let's come back. Where were we? We had discussed the borrowing aspect. Now, let's discuss the recovery of loans aspect and capital receipts. Head. So, in case of the recovery of loans, the government grants various loans to the state government or the union territories. So the recovery of such loans is a capital receipt as it reduces the assets of the government, as we had just discussed. Now, other receipts. Other receipts are basically like disinvestment or small savings. This investment basically refers to the act of selling a part or the whole of share of selected public sector undertakings held by the government. They are termed as capital receipts as they reduce the assets of the government. The government holds the ownership in various public sector undertakings in the form of equity shares. When the government sells a part or whole of its shares, it leads to the transfer of ownership of the public sector undertakings to the private enterprises. Am I right? Now, let's discuss another aspect, that is small savings. The small savings refer to the funds raised from the public in the form of post office deposits, national savings certificates, that is NSCs, then Kisan Vikas Patras, etc. They are treated as capital receipts as they lead to an increase in the liability. So these are very practical examples which we go through in our lives while going to the newspaper or while going to any news channel. These are very commonly used terminologies. Now you must be able to categorize these particular heads, whether under revenue receipts or capital receipts, as we are developing a very broad framework. So, my dear friends, let's again understand the difference between the revenue receipts and capital receipts. In terms of meaning, the revenue receipts neither create any liability nor reduce any asset of the government, that is tax revenue and non-tax revenue. However, on the other hand, in case of the capital receipt, they either lead to the creation of any liability or reduce any asset of the government, as we have just discussed in case of borrowings, creation of more liabilities, the recovery of loans, reduction of assets, and other receipts like disinvestment and small savings. Correct? Then, in case of revenue receipts, if we talk about future obligation, there is actually no future obligation from the side of the government to return the amount, like for the tax revenue, be it the direct tax or indirect tax, or for the non-tax revenue. There is no obligation to return the amount. However, in case of the capital receipt, in case of borrowings, recovery of loans, and other receipts, there is the future obligation. There is the future obligation to return the amount along with the interest. If we talk about the borrowings, as we have just discussed, we need to pay the principal amount as well as the interest in the near future. So, the examples of the revenue receipts are tax revenue, like income tax, then corporation tax, goods and services tax, etc. And the non-tax revenue, like interest, fees, escheats, gifts and grants, forfeitures, special assessment, etc. And the examples of the capital receipts would be borrowings, recovery of loans, and then other receipts, which can be either disinvestment, and small savings. Now, how to classify a particular receipt as the revenue receipt or the capital receipt? This is actually very important because in the practical life we are presented with any particular receipt, with any particular terminology. Now, how we will classify them as the revenue receipt or the capital receipt? We have developed the theoretical understanding. Now, what's the practical utilization? Let's understand. A receipt is a capital receipt. You must be able to recollect. Yes, try. I'm giving you some time. Now I'll let you know. A receipt is a capital receipt if it either creates a liability or reduces an asset. Correct? And a receipt is a revenue receipt if it neither creates a liability nor reduces any asset. I know now the examples of both these categories must be coming in your minds as we have developed a very broad understanding till now. Now let's go through various items and categorize them as the revenue receipt or the capital receipt. This is a very useful exercise and this will help you to get a very broad understanding and it will also help you to revise these concepts. Loan from the World Bank. Yes, the term loan, and it's from the International Financial Institution. It's the capital receipt because it creates a liability for the government here. Borrowings, capital receipt. Now, corporation tax or the income tax received by the government. Tax revenue. So it is the revenue receipt and obviously revenue receipt. Next, grants received from the World Bank. Grants received from the World Bank. We know that the gifts and grants received, they are not supposed to be returned, right? So obviously this would come under the category of non-tax revenue. That is the revenue receipt, as it does not lead to the creation of any liability nor it will lead to the reduction of any asset for the government. Next, profits of public sector undertakings. Profits for public sector undertakings. These are the profits. Obviously, these are the revenue receipts. Then, sale of the public sector undertaking, or we can also say the receipts from the sale of shares of a public sector undertaking or disinvestment. These are the capital receipt because they basically lead to the reduction of asset of the government. I hope you must be familiar with the concept the concept of how to categorize them as the revenue receipt or the capital receipt, and that concept is whether it will lead to the creation of any liability or whether it will lead to the reduction of any asset. This is the basic understanding. So accordingly differentiate, accordingly identify whether it's the revenue receipt or the capital receipt. Then the foreign aid against the earthquake victims. It is the foreign aid, it is the grant, so obviously it's the revenue receipt. Dividends on investment made by the government. Think whether it will create any liability or will it reduce any asset. Dividends on the investments made by the government. No. So obviously it's a revenue receipt. Then borrowing from the public, capital receipt. Then you must be having the imprint of this particular chart in your mind. Permanent imprint. Capture a pic of this particular board. Then the fees of the government college, it's the revenue receipt. Then finally, the tax receipts. Tax receipts are the revenue receipts. Now, my dear friends, we are moving on to the next component of the budget, that is called budget expenditure. Now, likewise, it is again classified into revenue expenditure and capital expenditure, right? And these are also having the basic fundamental, right? That is, the revenue expenditure neither creates an asset nor reduces any liability, right? Similarly, the capital expenditure, on the other hand, the capital expenditure either creates an asset or it reduces a liability. Now, if we talk about the term receipt and the term expenditure, why do we incur the expenses? Obviously to purchase something, correct? To purchase something, we need to incur the expenses. Now, if we are incurring the expenses, that means that we are purchasing an asset, right? It will help in building up our inventory. So that will come in the creation of an asset. Or if we repay for certain loans, right? If we repay for the certain loans, that means we are reducing our liabilities. So it comes here, capital expenditure. On the other hand, we also incur the expenses which neither create an asset nor reduce any type of liability. Think, what type of expenses can be under this category, that is the revenue expenditure. We will be discussing all these aspects in great detail, but in order to develop the proper understanding, we need to be familiar with these terms. The revenue expenditure refers to the expenditure which neither creates any asset, nor it reduces any liability of the government. That is, it is recurring in nature. It is incurred on normal function of the government and the provisions for various services. For example, yes, here comes the example of the revenue expenditure. That is, the payment of salaries, pensions, interests, expenditure on administrative services, defense services, health services, grants to the state. These are the normal expenses incurred in the daily routine by the government. As in case of revenue receipts, there was the income of the money, that is the receipt, which are recurring in nature. What is the regular income of the government, which is routine wise in nature? That is the tax revenue, direct taxes, indirect taxes, non-tax revenue, right? Similarly, if we categorize the revenue expenditure, we will talk about the regular expenses of the government incurred in daily routine. That is the payment of salaries, pensions, interests, expenditure on admin services, defense services, health services, grants to the state. And obviously, they will not create any asset building, nor will they reduce any type of liability. So, an expenditure is a revenue expenditure if it satisfies the two essential conditions, that is, neither the creation of any asset nor the reduction of any type of liability. That is, both conditions should be met, right? For example, the payments of salaries or pension is the revenue expenditure as it does not create any asset. However, the amount spent on the construction of metro is not a revenue expenditure, right, as it leads to the creation of an asset, right? We are giving these examples here simultaneously, that is, we are giving these examples together in order to develop a proper and clear understanding of how to differentiate between revenue expenditure and capital expenditure. Next, this type of expenditure, that is the revenue expenditure, must not cause the decrease in any liability. For example, the repayment of the borrowings is not the revenue expenditure. First of all, it is not the routine activity. Moreover, it is actually leading to the reduction of liability. That is the repayment of the borrowing. Right? So, I hope you must have developed a broad understanding of this particular framework. Now, we move towards understanding the conceptual definition of capital expenditure. Capital expenditure basically refers to the expenditure which either creates an asset or it reduces the liability of the government. Now obviously it is non-recurring in nature, that is, these types of expenses are not incurred on routine basis. Moreover, it adds to the capital stock of the economy and increases its productivity through expenditure on long period development programs like metro or flyover. The examples can be like loan to states and union territories, expenditure on building roads, flyovers, factories, purchase of machinery, repayment of borrowings, etc. Correct? Now, an expenditure is basically a capital expenditure if it satisfies any one of the following conditions. This is the basic revision. That is, either the creation of an asset or the reduction of the liability. So, again, let's understand the difference between revenue expenditure and a capital expenditure in a tabular manner. First of all, on the basis of the meaning, the revenue expenditure neither creates an asset nor reduces any liability. On the other hand, capital expenditure either creates an asset or reduces the liability. Secondly, the revenue expenditure is incurred for normal running of the government departments in the provision of various services, which are the routine services. Whereas the capital expenditure is incurred mainly for the acquisition of assets and granting of loans and advances. Thirdly, the revenue expenditure is basically recurring in nature. As such, the expenditure is spent by the government on day-to-day activities, whereas this is not recurring in nature, that is the capital expenditure. The examples of the revenue expenditure can be like salary, pension, interest, etc. Whereas the capital expenditures examples can be the repayment of borrowings, which reduces the liabilities, expenditure on acquisition of capital asset, that is leading to the creation of an asset. So this is the basic understanding. Now, my dear friends, let's analyze how to identify. This is the last exercise of this particular type. That is how to analyze whether the given expenditure is revenue expenditure or capital expenditure. We are gradually moving towards the concept of the budgetary deficit, but this is actually a very important step as of now. That is how to differentiate between the revenue expenditure and capital expenditure. An expenditure is basically the capital expenditure if it creates an asset, or it will be the capital expenditure if it creates an asset or it will reduce the liability. On the other hand, it will be the revenue expenditure if it neither creates an asset nor reduces any type of liability for the government. Now, we will be going through an exercise. I'm going to state certain items and you need to see whether these can be categorized as the revenue expenditure or the capital expenditure, correct? So let's start. Subsidies. Subsidies is actually the revenue expenditure. The basis for identification is whether it is creating any asset or whether it is reducing any type of liability. This is the basic foundation which should be there in your mind while distinguishing between the revenue expenditure and the capital expenditure. So, next is defense capital equipment purchased from Germany. Obviously, it is creating an asset, so it will be like capital expenditure. And then expenditure incurred on administrative and defense services. Yes, it's a revenue expenditure. Then the expenditure on purchasing computers. It's a routine activity, correct? but it also increases, it actually increases the assets of the government. If we are purchasing the computers, it is basically leading to the increase in the assets. So it will be the capital expenditure. But it is non-recurring activity. That's why another basis for identifying is that it is the non-recurring activity. So that's why it will be the capital expenditure. Then the expenditure on scholarships. Obviously, it is not leading to the creation of any asset for the government, nor it is reducing any type of liability. So it will be the revenue expenditure. Now, my dear friends, before moving towards the measures of government deficit, right? Obviously, we need to be in a balanced state or in a surplus state. If I talk about the favorable position for the entire economy of a particular country, right? But if I move towards this particular topic, let's understand various types of budget. Obviously, the difference between the government receipts and the government expenditures may be surplus or deficit, as the case may be. That is, either the revenue receipts may be more than the revenue expenditure, or the revenue expenditure may exceed the revenue receipts, right? Then it would be an unfavorable situation, like it would be the revenue deficit. If the expenses are increasing, if the expenses are more than the receipts, it is the deficit. It is a deficit situation. And if the receipts are more than the expenditure, it is the surplus situation. So if I talk about the budget receipts and budget expenditure, that is the total receipts and the total expenditure. So the basic definition of the budgetary deficit would be total expenditure minus total receipts. That is here. Total expenditure minus total receipts. Total expenditure minus total receipts. Right? That is the sum total of the respective components under the given category, and then finding out the difference between the budget expenditure and the budget receipt. That would be the budgetary deficit. Now let's come back to actually discuss the types of budget. Basically, the budget can be either the balanced budget, surplus budget, or the deficit budget. So the government budget is said to be the balanced budget if the estimated government receipts are equal to the estimated government expenditure. If the estimated government receipts are equal to the estimated government expenditure, that is the balanced budget. Then comes the surplus budget. If the estimated government receipts are more than the estimated government expenditures, that would be termed as the surplus budget. I would like to bring to your notice that the surplus budget basically helps to reduce the level of aggregate demand in the economy, which is required during excess demand to control inflation. Then comes the deficit budget. If the estimated government receipts, are actually less than the estimated government expenditures, that is, if the expected inflow is less than the expected outflow of money, then that is the deficit situation, that is the deficit budget. Correct? Now, my dear friends, moving ahead, let's discuss the measures of government deficit. The budgetary deficit here, it is a very, very important concept, my dear guys. The budgetary deficit is actually defined as the excess of total estimated expenditure over the total revenues. Here I've represented the total revenue by the abbreviation TE, and TR is the abbreviation for total revenues, estimated total revenues for the government for a particular fiscal year. Correct? So the difference would be the budgetary deficit. On the other hand, if the total revenues are more than the total expenses, that would be the budgetary surplus. But as of now, we are discussing the concept of budgetary deficit. So that will be the difference between the estimated total expenditures and the estimated total revenues for a particular fiscal. Correct? Now, with reference to the budget of the Indian government, the budgetary deficit can be of three types. That is, the revenue deficit, fiscal deficit, and primary deficit. Correct? Now let's explore various types of deficits, these three different categories. First of all, let's discuss revenue deficit. As the name is suggesting, and I had just given you the overview of this particular concept while developing the overall understanding of the term deficit, budgetary deficit. I had given you the hint, right? So as the name is suggesting, revenue deficit, bifurcate. Yes, bifurcate. Revenue, correct, we know. Revenue expenditure, revenue receipts. And then deficit, we know where the deficit is a situation when the expenses are more than the revenue generated, the receipts generated. When the expenses are more than the receipts, that is the situation of the deficit, right? So revenue deficit would obviously be the difference between the estimated revenue expenditure and the estimated revenue receipts for a particular fiscal year. That is, the revenue deficit refers to the excess of revenue expenditure over revenue receipts. So, revenue deficit is equal to revenue expenditure minus the revenue receipts. Correct? I hope when I use the word revenue receipts, what all is coming in your mind? Revenue receipts, tax revenue, non-tax revenue, direct taxes, indirect taxes. Then in case of non-tax revenue, what are the various bifurcations? Gifts and grants. Then what all? Like fines and penalties, profits, dividends. Right? Now, revenue deficit basically signifies that the government's own revenue is basically insufficient to meet the expenditures or the normal functioning of the government departments and provisions for the various services. So my dear guys, if I'm using the term revenue, you must be having in the back of your mind that this term is used for the routine or recurring activities. So that's why I would like to repeat this once again. Revenue deficit signifies that the government's own revenue is insufficient to meet the expenditures on normal functioning of the government departments and provisions for various services. Now, let's discuss various implications of revenue deficit. Basically, it indicates the inability of the government to meet its regular and recurring expenditure in the proposed budget, as we have just discussed. Secondly, it implies that the government is actually dissaving, that is, the government is using up the savings of the other sectors of the economy to finance its consumption expenditure. Thirdly, it also implies that the government has to make up this deficit from the capital receipts. Correct? That is through borrowings, or disinvestments. It means that the revenue deficit either leads to an increase in liability in the form of borrowings, or reduces the assets through disinvestment. So obviously it leads to a vicious cycle. The use of the capital receipts for meeting the extra consumption expenditure leads to an inflationary situation in the economy. Higher borrowings increase the future burden in terms of loan amount and interest payments, and increase in such interest burden will actually lead to the increase in the revenue expenditure in future, and this will result in further rise in the revenue deficit. So this is the vicious circle, and that's why it is actually very, very important to pay a lot of emphasis towards these concepts in order to avoid such a situation of actually approaching this particular step of borrowings or disinvestment. These steps should be avoided at the best possible level. So our strategies need to be very, very far-sighted, and as we had discussed in the beginning of our session, that the pre-budget meetings are being held with various economists, and the overall ministerial panel is sitting together under the leadership of the respected Prime Minister. So these types of meetings are actually very, very important. Very important before coming up with the final budget. Right? Now, if I use the term budget, in the back of your mind, you must be getting all these terms. That is, what are the objectives of the budget? What are the budget receipt? What are the budget expenditures? Revenue receipt, capital receipt, tax revenue, non-tax revenue, borrowing, recovery of loans. All these concepts must be crystal clear in the back of your mind. And these concepts must be on your tips. So let's come back. We were discussing the implications of the revenue deficit. So the use of capital receipts for meeting the extra consumption expenditure leads to an inflationary situation in the economy. The higher borrowings increase the future burden in terms of loan amount and interest payments, and hence increase in such interest burden will finally lead to the increase in revenue expenditure in future. This will finally result in further rise in the revenue deficit. A high revenue deficit gives a warning signal to the government to either curtail its expenditure or increase its revenue. Now, according to the far-sighted approach, the revenue receipts should always be more than the revenue expenditure. The revenue receipts must always be more than the revenue expenditure for a very favorable situation of an economy. So that the surplus of this particular difference, that is the revenue receipts minus the revenue expenditure, actually this should be the other way around. There should not be the revenue deficit, there should be the revenue surplus. So if there is a revenue surplus, the revenue receipts should always be more than the revenue expenditures, so that the surplus can be used for the development projects. However, sadly speaking, Indian budget is facing the revenue deficit for the past several years. Now, what are the various measures to reduce the revenue deficit? Either reduce the expenditure or increase the revenue. That is, the government should take serious steps to actually reduce its expenditure and avoid unproductive or unnecessary expenditure. On the other hand, the government should also increase its receipts from various sources of tax revenue and non-tax revenue. Now, let's discuss another category of budgetary deficit, that is the fiscal deficit. So as the name suggests, it is actually the total estimated expenditure minus the total estimated receipts, excluding the borrowings. Fiscal deficit actually presents a more comprehensive view of budgetary imbalances. It is widely used as a budgetary tool. For explaining and understanding the budgetary developments in India. The fiscal deficit refers to the excess of total expenditure over total receipts, excluding the borrowings during the given fiscal year. Right? So the extent of the fiscal deficit is an indication of how far the government is spending beyond its means. How far the government is spending beyond its means. Now, what are the various implications of fiscal deficit? The implications of fiscal deficit are actually like debt trap. The fiscal deficit indicates the total borrowing requirements of the government. Actually, fiscal deficit is also equal to the total borrowings. If we consider this definition or this equation in a more comprehensive and broad-minded manner, we would find out that fiscal deficit is equal to the total borrowings. So fiscal deficit basically indicates the total borrowing requirements of the government. Borrowings not only involve the repayment of the principal amount, but also require the payment of interest. The interest payments increase the revenue expenditure. The interest payments would obviously increase our revenue expenditure, right? Which leads to, now if the revenue expenditure increases, this would obviously lead to revenue deficit. So it creates a vicious circle of fiscal deficit, then the revenue deficit, wherein the government takes more loans to repay the earlier loans. That is the increase in the total number of liabilities. As a result, the country is caught in the debt trap. So obviously such situation is actually not favorable. Next, inflation. The government mainly borrows from the RBI, that is the Reserve Bank of India, to meet its fiscal deficit. The RBI prints new currency to meet the deficit requirements. It increases the money supply in the economy, which leads to the increase in the general price level and hence creates the inflationary pressure. Then, next implication of fiscal deficit is foreign dependencies. Actually, the government also borrows from the rest of the world, which raises its dependence on the other countries. Moreover, it also hampers the future growth. The borrowings increase the financial burden for future generations, so it adversely affects the future growth and development prospects of the country. So the main implications of fiscal deficit are debt trap, inflation, foreign dependence, and hampering of the overall future growth. So fiscal deficit basically gives borrowing requirements of the government. So it must not be allowed to rise beyond manageable limits, that is beyond the threshold limit. The safe limit of the fiscal deficit is actually considered to be 3% of the gross domestic product. Greater fiscal deficit implies greater borrowings by the government. So high fiscal deficit is inherently bad for the overall health of an economy of a particular country. Now, dear friends, how can we calculate the fiscal deficit? Basically, fiscal deficit, as mentioned here, is the difference between the total expenditure and the total receipts excluding the borrowings. Next definition is revenue expenditure. If we further elaborate, what is the total expenditure? Total expenditure is basically the summation of revenue expenditure I mentioned here. Total expenditure is also equal to revenue expenditure plus capital expenditure, correct? So we can say that fiscal deficit is also equal to revenue expenditure plus capital expenditure minus capital expenditure minus capital receipts, right? And excluding the borrowings. So if so it can be said, finally we will come to a point when fiscal deficit is equal to revenue deficit plus capital expenditure minus capital receipts excluding the borrowings. Here, I mentioned it here. Fiscal deficit is at 1 minute. Actually, this is very important, so I'm mentioning it here as a note. See, we have learned that fiscal deficit, I'm representing it as FD. It is represented as the difference between total expenditure minus total receipts, excluding the borrowings. Right? So, if I further bifurcate total expenditure into capital expenditure plus revenue expenditure minus capital receipts plus revenue receipts excluding the borrowings. Right? Now, I can write it as, if I open a bracket, revenue receipts minus revenue receipts, revenue expenditure minus revenue receipts would be revenue deficit, right, plus capital expenditure minus capital receipts excluding the borrowings, correct? So, as I have mentioned here, it is equal to revenue deficit plus capital expenditure minus capital receipts excluding the borrowings. This is the final definition of fiscal deficit. And also at times the total borrowings are only the total borrowings are given. In such a case, fiscal deficit is equal to total borrowings. Right? Fiscal deficit is equal to total borrowings. So if we draw the comparison between revenue deficit and fiscal deficit, let's see. If we talk in terms of meaning, fiscal deficit allows the excess of total expenditure over total receipts excluding the borrowings. Yes. And on the other hand, revenue deficit shows the excess of revenue expenditure over the revenue receipts. Very true. Next, in terms of indicator, fiscal deficit measures the total borrowings requirements of the government. Fiscal deficit represents the total borrowing requirements of the government, right? Whereas the revenue deficit indicates the inability of the government to meet its regular and recurring expenses, as we have just discussed. Now, as fiscal deficit is a very important concept, let's understand how to basically source, how to basically find out the sources for financing the fiscal deficit. The government has to actually look out for different options to finance the fiscal deficit. The main two sources are borrowings and deficit financing. Now for borrowings, the fiscal deficit can be made by borrowings from internal sources like public or commercial banks or external sources like foreign governments or international organizations, as we have just discussed here. Then, in terms of deficit financing, that is the printing of new currency, the government may borrow from the RBI, that is the Reserve Bank of India, against its securities to meet the fiscal deficit. The RBI issues new currency for this particular purpose, and this process is known as deficit financing. The borrowings are now, if we analyze that which option is actually much better, that is whether borrowing or deficit financing to deal with a situation of fiscal deficit, the borrowings are actually relatively better option. Why? Here is the reason. Borrowings are considered a better source as they do not increase the money supply, which is regarded as the main cause of inflation, right? On the other hand, deficit financing may lead to inflationary trends in the economy due to more money supply, which is being done deliberately to deal with the fiscal deficit. Now, the last category of budgetary deficit is primary deficit. The primary deficit refers to the difference between the fiscal deficit and the interest payments on the previous borrowings. Here, fiscal deficit minus the interest payments. I hope it's visible to all of you. Primary deficit is the difference between the fiscal deficit and the interest payments. Interest payments on the previous borrowings. So, the total borrowing requirement of the government basically includes the interest commitments on the accumulated debts. The primary deficit basically reflects the extent to which such interest commitments have compelled the government to borrow in the current period. Very true. You might be aware of the fact that fiscal deficit represents the amount of borrowings to be done by the government. Now, let's analyze the situation when I represent it here because of the lack of space. I'm sorry for this particular constraint. I'm representing primary deficit by the acronym PD. According to definition, primary deficit is the difference between fiscal deficit and the borrowings, correct? Sorry. Fiscal deficit and interest payments. So, if the primary deficit is zero, if we are assuming a situation when primary deficit is zero, so what does that mean? That the amount of borrowings is equal to the interest payments, right? That means as fiscal deficit represents the borrowing, so that means borrowings are equal to interest payments. So this means that the government has to borrow only on account of the interest payments if primary deficit is zero. Now, this means that primary deficit is the root cause of fiscal deficit. In India, the interest payments have considerably increased in the recent years. High interest payments on past borrowings have greatly increased the fiscal deficit. I repeat, the high interest payments on the past borrowings have greatly increased the fiscal deficit. So in order to reduce the fiscal deficit, the interest payments should be reduced. The interest payments should be reduced to a very great extent through the repayment of loans as early as possible. Right? So now let's analyze the difference between the fiscal deficit and primary deficit. As per the definition, primary deficit is the difference between the fiscal deficit and the interest payments, right? On the other hand, fiscal deficit basically shows the excess of total expenditure over the total receipts, excluding the borrowings. Next, primary deficit indicates the total borrowing requirements of the government excluding the interest, right? Whereas fiscal deficit indicates the total borrowing requirements of the government including the interest. And the formula for primary deficit is fiscal deficit minus the interest payments, whereas the formula for fiscal deficit would be total expenditure minus total receipts excluding the borrowings. So dear friends, this is really amazing, the way in which we have discussed the entire framework of the government budgeting and economy. And obviously the objectives of the government budget, as we had discussed in the beginning, that is reallocation of resources, reducing the inequalities in income and wealth, economic stability, management of public enterprises, economic growth, reduction of regional disparities, and employment generation. Framing your entire framework for the budget, keeping in view these objectives, is the main aim of budget formation. And this is really very basic understanding of the process of budget making, and it is a very important aspect at the same time. So my dear friends, I really hope that this entire concept must have got crystal clear, but you would be required to go through this particular chart again and again and develop the proper understanding by reading the news on daily basis, so that you can actually conceptualize this particular concept, that is how we are relating all these studies, all these concepts in the practical in the practical scenario, in the realistic scenario. What are the various hurdles the government is facing during the process of budget making? What are the different opinions being given by the experts, various economists, and various different ministers of various domains regarding the suggestions in various pre-budgetary meetings, just to form a very effective budget? You must be understanding the overall importance of this particular process, that how important this task is. And this is of really great strategic concern, and this requires a lot of work, considering the present economic scenario across the entire globe, wherein we are seeing various economies facing the policy paralysis. But India is being regarded as the bright spot for the global economy. So in order to maintain this image, we really need to be very alert and aware of all these concepts. Even we, the normal citizens of the country, should be aware of this particular concept. This is of actually great importance. Then only we will be able to comprehend the actual status being presented to us in the form of newspaper or in the form of a journal. It is very important to read behind the figures. It is very important, and this is the responsibility of the citizen of a country. So I hope you understand the intensity of this entire matter and why we have devoted so much of time just to develop this understanding, because it's of crucial importance. It's of crucial importance, dear guys. So Please, it's my request that you all please take the picture of this particular board. This chart should be in your mind, right? And this is going to be very useful for your future references, whichever field you belong to, but this is of great relevance. So on this particular note, I would like to end today's session, and I really hope that you must have found this session very important, and very useful for developing the entire conceptual framework in a very precise and concise manner. So it was really a pleasure for me as well to actually conduct this session. Thank you so much. Namaskar. Jai Hind.